If you're new to investing and want to get started in 2025, this video is for you. I'm walking you through the ultimate beginner's guide to investing, breaking down the basics in simple, easy-to-understand steps. Whether you've been hesitant to dive in or just don't know where to begin, I'll explain everything from choosing the right investment accounts to understanding stocks, bonds, and mutual funds. Plus, I'll cover the new trends and opportunities in 2025 that could shape your financial future. No complex jargon, just practical advice to help you start building wealth, even if you're starting with zero experience. Let's jump in. Today, we will talk about the ultimate beginner's guide to investing in 2025. So before we get started, make sure to hit that like button. Also subscribe to my channel. 1. What is investing? A simple explanation. Let's start with the basics. What exactly is investing? Simply put, investing is putting your money into something with the goal of making it grow over time. Unlike saving, where you keep money in a low-interest account and let it sit, investing involves taking on some risk in exchange for the potential of higher returns. There are various types of investments, but all of them share one common goal: to increase your wealth. This can happen through capital appreciation, the value of an asset increasing, or income generation, earning interest or dividends. Investing isn't a get-rich-quick strategy. It's about patience, consistency, and making smart decisions that work for your financial goals. 2. Why should you start investing now? You might be wondering, why should I start investing in 2025? The short answer is, because the earlier you start, the more time your money has to grow. Time is one of the most powerful tools when it comes to investing. The sooner you invest, the longer your money has to compound. That means you earn returns on your initial investment, plus returns on the returns you've already made. It's like a snowball effect. Even small contributions today can lead to significant wealth down the road. Additionally, 2025 is an exciting time for investors. With new technologies, emerging markets, and innovative financial products, there are more opportunities to invest than ever before. The world of investing is changing, and now is a great time to get involved. 3. The different types of investments. There are many ways to invest your money. Let's take a look at some of the most common types of investments that beginners should consider. Stocks. Investing in stocks means buying a small ownership stake in a company. If the company grows and performs well, the value of your stocks will increase, and you may also receive dividends. Stocks can offer high returns, but they also come with higher risks. Bonds. Bonds are like loans that you give to governments or companies in exchange for regular interest payments. While bonds are generally less risky than stocks, they also tend to offer lower returns. They can be a good option if you're looking for stability. Real estate. Investing in property can be a great way to build wealth over time. Real estate investments can provide rental income and potential appreciation. However, real estate requires a larger upfront investment, and it's less liquid than stocks or bonds, meaning it can be harder to sell quickly. Mutual funds and ETFs, exchange-traded funds. These are pools of investments that allow you to invest in a wide range of stocks, bonds, or other assets. Mutual funds and ETFs are ideal for beginners because they provide instant diversification. Digital currencies like Bitcoin and Ethereum have grown in popularity in recent years. While they offer the potential for significant returns, they are highly volatile and speculative. It's important to approach crypto investments with caution and only invest what you're willing to lose. Commodities. These include things like gold, oil, or agricultural products. Commodities can be a good hedge against inflation, but they're also subject to market volatility. 4. How to choose the right investment for you. So, how do you decide where to put your money? The right investment for you depends on a few factors. Your financial goals. Are you saving for retirement, a down payment on a house, or just building wealth? Your investment choices will depend on your objectives. If you're saving for retirement, long-term investments like stocks or real estate might be ideal. If you are saving for a short-term goal, bonds, or a high-yield savings account might make more sense. Risk tolerance. Some investments, like stocks and crypto, come with higher risk, but they also offer higher rewards. Others, like bonds, are safer but offer more modest returns. Think about how comfortable you are with risk before choosing your investments. Time horizon. How long can you afford to leave your money invested? If you're saving for something that's a few years away, you might want to stick with safer investments. But if you're investing for retirement or a goal that's decades away, you can afford to take on more risk. 5. Setting up an investment account. Before you can start investing, you need to set up an investment account. There are several options. Brokerage accounts. A brokerage account is the most common way to buy stocks, bonds, and ETFs. There are plenty of online brokerage platforms like Robinhood, E*Trade, or Fidelity that let you start with as little as $1. Retirement accounts. These include accounts like IRAs, individual retirement accounts, or 401(k)s. These accounts offer tax advantages, but there are specific rules about when and how you can access your funds. Retirement accounts are ideal if you're looking to invest for the long term. Robo-advisors. If you're new to investing and don't want to make decisions on your own, robo-advisors can help. These platforms, like Betterment and Wealthfront, automatically invest your money for you based on your goals and risk tolerance. 6. Dollar cost averaging. A strategy for beginners. If the idea of investing a lump sum of money feels intimidating, consider the strategy of dollar cost averaging. This involves investing a fixed amount of money at regular intervals, such as monthly or quarterly, regardless of the market's performance. This strategy helps reduce the emotional aspect of investing. It also protects you from the risk of trying to time the market, which is nearly impossible. By consistently investing, you take advantage of both market highs and lows, helping to smooth out the ups and downs over time. 7. The power of compounding. One of the most important concepts you'll encounter when investing is compounding. Compounding means earning returns not only on your initial investment, but also on the returns that have been reinvested over time. This is why starting early is so important. For example, if you invest $1,000 and earn a 10% return, you'll make $100. But if you reinvest that $100, you'll earn interest on it in the next period. Over time, this snowball effect can lead to significant wealth accumulation. The earlier you start, the more time your money has to compound and grow. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.